Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. The Prime Minister made the first gaffe of the election season last week when he said that he didn't really think much about monetary policy. Like clockwork, Conservative leader Erin O'Toole jumped on to criticize the Prime Minister for what was obviously a very stupid statement. Erin O'Toole noted that I'm concerned about monetary policy because I'm concerned about the housing crisis. The fact that hundreds of thousands of Canadians are having trouble keeping up with their bills, the rising costs, inflation at 20-year highs doesn't seem to concern Mr. Trudeau. And yeah, I mean, obviously the major inflation that was announced last week, 3.7%, should be a huge concern to the Prime Minister, to the Bank of Canada, and I mean to all of us. But as mentioned, the Prime Minister said that he doesn't really think much about monetary policy.
Don't think about monetary policy?
For his part, David Dodge, former Bank of Canada governor, chimed in over the weekend saying that Trudeau was wrong and should apologize. With all of that said, there are major changes being talked about at the Bank of Canada and with our monetary policy that have still yet to be brought up in this election cycle that I want to go over. There are major role changes being talked about for the bank's mandate and how they handle inflation and employment. And I want to go over in this video the top 3 reasons why you need to think about monetary policy, even if our leaders aren't bringing them up during the election. So we'll talk about what changes are being proposed, what their implications are, and what it means for you. So up until now, the Bank of Canada has had a singular mandate, which was to promote the economic and financial welfare in Canada, done primarily through inflation control, meaning it's their job to keep inflation between 1% and 3%. How do they do that? Well, they do that through rate hikes or by lowering interest rates. So if inflation's running too hot, if inflation starts to creep up towards, say, 3%, they would increase interest rates, making it more expensive for business and individuals to borrow, which would put less money in the economy, which should help keep inflation down lower in check. If inflation started to get too low and they needed to stimulate the economy, they would lower interest rates. That means that you or I or businesses are more likely to borrow, we're more likely to invest and spend, which will help stimulate economic growth. It was kind of as simple as that, 1-to-1, and we saw it in 2017 and 2018 when we saw a total of 5 rate changes as a means to keep inflation under control. In 2017, inflation was 1.6%, and in 2018, it was 2.7%, and we saw multiple rate hikes to kind of keep that inflationary pressure in check. Fast forward to the pandemic, and in March of 2020, the Bank of Canada worried that nobody was going to be spending, everybody was panicking, you couldn't get toilet paper, if everybody remembers. The Bank of Canada lowered rates to almost to near 0%, so that making it more just to incentivize people to borrow and spend, and just as a means for us to keep our economy going, even on a subsistence level, even if as much as it could. So they made it as cheaply as they could to keep people from borrowing, or no, to keep people borrowing, and that kind of helped our economy limp along even during the lockdowns. So we see that with strict 1-to-1 ratio. Inflation gets too high, you raise rates. Inflation gets too low, you lower rates. That's been the bank's mandate for at least the last 5 years. This was agreed to between the federal government and the Bank of Canada in 2016, with this agreement to be renewed come 2021. However, and this is what Trudeau was being asked about last week when inflation came out, that last month's inflation was 3.7%. Given that we saw rate hikes prior when inflation was around 2.7%, if we're at 3.7, we would expect a rate hike to be incoming, and the Bank of Canada isn't hiking rates. What they're doing is moving towards more of a dual mandate role, where they not only try to keep inflation in check, keep it between that 1% and 3%, but also try to help the country get to full employment. So that's where everybody that wants a job has a job. So what they're arguing is that and I've done a video about what they're doing before. What they're arguing is that it's by letting inflation run really hot right now, that should help get us back to full employment, and at that point they can lower rates. However, the Bank of Canada doesn't have this mandate yet. This is going to be renewed, or should be renewed, in 2021, but they haven't been told by the federal government as of yet that this is what they're supposed to be doing. They've been studying it for a few years now, and the Federal Reserve has this dual mandate where they provide for inflation, or they look after inflation and they look after full employment, and obviously it looks like it's coming here to Canada. So what? The Bank of Canada wants to keep a check on inflation and provide for full employment. That sounds great, but there's three big implications for that, which is why you need to think about monetary policy, even if the Prime Minister says he's not doing it. One of the first and maybe one of the biggest reasons why you need to think about whether or not the bank should have this dual mandate is interest rates. If we look at previous times that interest rates were lower or raised, it was kind of predictable right before it happened. The Bank of Canada makes their interest rate decisions every couple of months. So we kind of knew, based on the inflation data, what the bank was going to do. As a result, brokers, bankers, self-employed people, anybody and everybody whose livelihood depends largely on interest rates, and that includes many homeowners, were able to sort of make decisions based on the future because they kind of knew what the Bank of Canada was going to do based off the inflation data. Inflation's running hot, they're going to lower rates. Or no, they're going to raise rates. Inflation's running really low, they're going to lower rates in order to stimulate the economy. It was very one-to-one, and a lot of the articles, if you go back on a quick Google search, will bear that out. However, if the Bank of Canada changes over to this dual mandate, well, we don't always know where are they going to put the most focus on. Is it going to be full employment? Is it going to be interest rates? How hot are they going to let inflation run? These are the types of things that we need to think about, and the leaders, Trudeau, O'Toole, and Singh, need to be discussing, even though they haven't brought it up yet, if they're going to bring it up at all. These kind of things need to be discussed because the Bank of Canada gets this authorization from the federal government, who get their legitimacy from the people. So this needs to be brought up, whether or not this is what we want the Bank of Canada to do, and if they are going to have a dual mandate, where are they gonna put the most focus on? Is it going to be inflation, or is it going to be full employment? Businesses need predictability. Households need predictability. Everybody needs at least a modicum of predictability. And this needs to be brought up by our leaders so that the Canadian people can have at least an idea of what is going on in our monetary policy and the prospective changes to it. Second, your price of goods. If there's a big change in monetary policy at the Bank of Canada, it is going to affect everyday people. Up until now, if inflation's the main driver, inflation's the main thing that the Bank of Canada is focused on, that 1 to 3% inflation rate, we've been able to sort of tell what inflation is going to be at over the coming months and years ahead. But if they start focusing on employment as well, and full employment, not that that's a bad thing, full employment's great, but it will come at a cost. Inflation, if allowed to run hot, is going to make things more expensive. It's going to make everyday goods, as well as household goods, cars, everything that we've already seen have been going up and up and up for the past 18, 20 months, past 2 years really. We've seen the prices of everything really start to shoot up. Well, that's going to be more and more the case if the Bank of Canada is allowed to move to this dual mandate, where they allow inflation to go much higher than usual in order to provide for full employment. And again, just like with the interest rate predictability, this is a discussion for the Canadian people. Is this what we want? And it hasn't been brought up yet. And when it was brought up to Prime Minister Trudeau, he said he doesn't think about monetary policy, even with these big changes coming in the next few months, an election happening right now. Third, and finally, with any big changes in government policy, and the Bank of Canada, although considered private, is a quasi-government institution. Any big changes, there are going to be winners and losers. As we already said, we might be able to get high employment, but it's going to come at a cost of higher price of goods. Well, in that scenario, there are winners and losers. There's going to be winners and losers, and it's going to change the current status quo if we do move to this dual mandate. So our leaders need to be talking to us. We need to be thinking about this, as it's going to very much affect how things move in the future, and what your price of your house is, how you decide whether or not you're going to get a variable or a fixed rate, where you put your money, how you spend on your credit cards, how businesses invest, etc., etc., etc. This is a big change that's coming, a big change that's being considered, and for Prime Minister Trudeau to say he doesn't think about monetary policy when he knows full well that a big change is being proposed at the Bank of Canada is wrong. And we need to hold him account for that, especially right now with an election happening. So in summary, with us no longer being able to predict interest rates as well as we can, no one has a crystal ball, obviously, but it was sort of a quasi-good indicator if the rates were going to go up or down was an inflation target. The higher price of goods, that will surely come if the bank has its dual mandate. And a drastic alteration in the distribution of goods and the winners and losers, be it those in real estate, those in finance, those with small businesses, homeowners, soon-to-be homeowners, first-time home buyers, etc. The Bank of Canada taking on a dual mandate rather than just focusing on inflation will have a big effect on all of us. So if the Prime Minister isn't going to think about it, and we're not really going to talk about it on this election, then you definitely need to think about monetary policy. If you like this video, please do click like and subscribe. We'll have more videos as they come out, as more news comes out. The Liberal Party still hasn't released its election platform, which is baffling to me, given that the election was called well over a week ago. So they either don't have it ready, which I can't imagine that's the case, or this is strategic and they're waiting till we're closer to voting day as they want to hold the news cycle. With that said, once the Liberal election platform is released, we'll have a video on it and see what they plan to do with Canada's real estate and their mortgages. Thanks so much for watching, and we'll see you again.